Welcome back. Well, oil prices are heading for a weekly dip as the dollar strengthens. And here to discuss the implications of that is Stephen Schork, the Schork Group principal. Sir, thank you so much for your time here. Tell me, how much does the dip remind us that oil prices aren't just about supply and demand and the balance between them, but also monetary policy?
Yeah, absolutely. To your point, supply demand, of course, but there are other exogenous factors that impact all commodity prices. Certainly monetary issues, geopolitical issues that we're seeing now in Belarus, weather issues, and pure out speculation. To go back to monetary policy, a stronger dollar is bearish for all commodity prices. So there is that inverse relationship. Commodities, for the most part, global commodities are priced in US dollars. So when the dollar strengthens, that makes commodities more expensive in non-dollar denominated economies. So a stronger dollar is bearish for oil and for all commodity prices for that point.
Yeah, and Stephen, I mean, when we talk about what President Biden wants to do about this, he's said that it's a top priority to kind of reel in inflation. And obviously, gas prices are a key thing that American consumers pay attention to. We've been talking this week about people reporting seeing stickers at the pump of President Biden pointing to the gas prices, saying, I did that. A lot of Republicans chiming in about how much this is to fall on his shoulders. And I don't know how fair that is, obviously, right? When we're coming out of a supply crunch in the pandemic and kind of the supply and demand dynamics of all this. But you've been kind of pointing out that there are some pieces that he could pull here to kind of alleviate some of the pricing pressure. How do you rate it?
Yeah, absolutely. The fundamental shift we've seen to higher prices, look, fundamentals don't move that fast. This has been, to your point, in the process of building prior to the Biden administration. Biden certainly is not helping it with the rhetoric that we are seeing because he's violating the first lesson of economics, and that is to say that capital goes where it's welcome, stays where it is well treated. And clearly, capital is not welcome in the fossil fuel industry. So we will reap the unfortunate benefits, if you're bullish, of higher oil prices for years to come. Now, in the here and the now, what we are seeing, certainly there is that fundamental shift in the market. And a lot of this is based on geopolitics outside of our own borders. We have the situation now in Belarus, where Belarus now is threatening to cut off gas supplies going into Poland and to the rest of Europe. This is a problem because a month ago, because of low supplies of natural gas and a lack of renewables to compensate for that, you had natural gas prices in Europe trading the equivalent of $230 of crude oil. So it is inflation all around the board. The White House's ability to address this is rather limited. Some of the prospects that we've heard are a release of barrels from the Strategic Petroleum Reserve, but we have to keep in mind, we do not use crude oil, that is the consumer. We do not put crude oil into our cars. We do not put crude oil into our furnaces. We put the refined product of crude oil in. So yes, putting more crude oil on the market, yeah, that's going to put more oil onto the market, but not necessarily what we need because of our refinery capacity to turn that crude oil into what we need. The other aspect that we're looking at is a potential ban on crude oil exports. Once again, we're going to back up crude oil, and that doesn't help either because the United States does not burn necessarily the oil we use. We produce a very high quality oil. Our refineries in the United States are the most sophisticated in the world. They are capable of burning a heavier, dirtier crude oil, which is cheaper. So what we do here is we export our caviar and we buy back tuna fish. Now, if you cut off those bans, we're not going to reap the benefits of those higher priced crude oil barrels. And all it's going to do is back up crude oil in the United States. And once again, we don't necessarily need it because we can't necessarily refine it into what we really need. So we're not looking at policies that would necessarily are going to move the market from a fundamentally driven standpoint.
And then as well, the president has been pushing OPEC Plus to release more oil, turn on the tap, but they have refused to do that. I want to turn your attention now, though, to natural gas. And you say in your note that natural gas is a consummate contrarian. What do you mean by that?
Yeah, it's a contrarian market. Natural gas has two seasons. Of course, the heating season during the winter when we burn natural gas to heat our homes, And in the summer, when the utilities burn natural gas to create electricity so we could run our air conditioning. So once we get into the shoulder months, late August, September, October, and then, of course, April, May, and early June, demand hits its nadir. So we are looking at natural gas that is just coming out of its weakest demand of the season. And yet a month ago, natural gas prices hit a 10-year high. Counterintuitive because demand is at its weakness. And what tends to happen if we look at history going back since 1990, when natural gas became a regularly commercially traded market, 68% of the time we've seen the high in natural gas prices for the winter put in before the start of winter, i.e. the solstice on December 21st. And nearly 60% of the time, we've seen the high in natural gas prices by the end of November. In fact, over the last 30 years, the average high price for each winter has occurred on November 30th. So 2 months prior to the coldest part of winter. So it is that contrarian play where if you know a little bit of history, you bought into this rally, but you're certainly not holding on to your natural gas prices, because historically we're going to see a retracement in prices as we enter and go through winter.
Lastly, Stephen, just to kind of wrap up here, when we look at oil prices now down third week straight, worst stretch in March. I mean, when you look at kind of where it could go, it would seem odd if we just kind of level out at 80 and stay here versus, everything we've seen up until this point. Where do you see it going if we do particularly see a pretty rough winter? Where the price of oil goes to year end in your eyes?
Year end, we have to keep in mind that bets on $100 crude oil between December of this year out through December of next year, open interest, the amount of contracts of people betting on $100 oil has risen 500% since the start of this year. So there's a considerable amount, put it this way, there are people betting on $100 oil. The volume of those bets could refill the NYMEX Cushing's storage complex 5 times over. So clearly, if we have a rough winter, we are going to see, and yes, $100 plus oil is certainly a possibility. So we should be happy with gasoline prices at $3.40. Keep in mind that these gasoline prices are winter grade gasoline prices. Winter grade gasoline to manufacture is much cheaper than summer gasoline. So if we do see $100 oil and we make that into the spring when we have to flip over to summer grade gasoline, which is much more expensive to refine, then we're looking at gasoline prices instead of $3.40 on a national average, we'll be paying closer to $4 a gallon, $6 if you're in California.
All right, so. Yeah, you can't forget the Californians who always get mad when we talk gas prices and say that's nowhere near what I'm paying. Stephen Schork, though, the man I like to call the Oracle of Oil.